Let's actually decode the market fundamentals and technicals as well. To hash out the technicals, we have Nirav Chheda as well as Nooresh joining us on the show. Nooresh, hi, good to have you back. I just wanted to understand from you, what do you make of the market setup right now? Finally seems like we are broken out of that range, and today we are not seeing that selling pressure that Ajay was alluding to. Would you take heart from this factor?
Absolutely. So if we look at the broader indices, the breadth is very strong today across the board, across all segments. And on the Nifty and the Bank Nifty, the concern is the two heavyweights have not done really well. So you have Reliance still struggling to cross that 2370 mark. HDFC Bank not able to cross 1500, but rest of the market looks interesting. So we've seen ICICI Bank make a reversal. We are seeing IndusInd Bank get closer to 52-week highs. So overall, stock-specific price action is positive. One can continue to look at more stock-specific action. And once we sustain 19,300, that is where one can start looking at the index.
Let's take trading ideas from our guest then. Nirav, now that we have established how the setup of the market appears on a Friday, tell us what are the stocks which look good on incremental trading business?
Hi everyone. Looking at the overall markets, first of all, if you see, for the last couple of days, you're seeing oil and gas sector as a whole performing quite well. So, be it OMCs, or the other companies like ONGC and probably Oil India, they're doing quite well. So, for today, I'd be focusing, in fact, for the next couple of days, trading days, I'd be focusing on oil and gas because there are good breakouts coming in most of the stocks. And that is why, keeping that in mind, I have HPCL, Hind Petro as a buy today. See, this stock, in fact, the OMCs haven't done much of late, but I'm seeing a bottom kind of a formation being made on the charts, and that is a very good sign. And this is the first time most of the OMCs, including HPCL and BPCL, are above their 200 and their 50-day moving averages, which is another positive. So HPCL can reach about 275 to 80 odd level, so that should be your target. 252 should be your stop loss. The second one is again a PSU. It's in the gas space now. GAIL India. Looking at the overall charts, a good breakout had come in for this stock around that 113, 114 odd levels. The stock came down to retest those levels and is now seeing a good reversal. Again, most of the indicators are positive. Even this stock for today is, probably going to close above its 50-day moving average, which is a very important support level for this particular stock, at least on the upside. So, it's a strong closing that is coming in. Again, presumption is that it will close above the 50-day moving average, which is around that 122 odd levels. So, keeping that in mind, by GAIL India, from trading perspective, 119, 118 are good support areas, so that becomes your stop loss. I believe this stock has it in it to move up towards that 135, 140 odd levels. So definitely, go ahead and buy this stock for that those levels.
Taken. Actually, Nirav as well as Nooresh, hold that thought. We'll come back to you shortly. But we also have Vinay Paharia, the CIO from PGIM India, joining us on the show. Vinay, hi, this is Anisha this side. Good afternoon. Thank you so much for making time. Wanted to begin by asking you your market outlook in terms of how the valuations stack up versus the earnings growth that we have seen in the quarter gone by.
Hi, Anisha. So I think jumping straight to valuations, definitely the valuations currently are at a premium and are seemingly capturing most of the fundamentals for the next 6 months to 1 year. So we have actually borrowed some returns from the future, and hence for the near term we are a little bit cautious purely on valuation reasons.
Good way, Vinay, which you always do, borrowed returns from future, essentially saying that returns will normalize from here on. In the last 3 years of CAGR, say suppose a fund is given 25, 30% or even individual stock, the next 3 years could be meaningfully lower. So expectation that similar performance gets repeated may not be a great idea. Tell us, which are the areas where you would be tempted to trim profits out of I'm not even talking about your fund. I'm talking about the overall market landscape. Which are the areas
Sure.
which warrant trimming?
In fact, Ajay, we have done recently a study of the market which tells us that weaker quality companies, which means companies which have got lower than average return on equity and companies which have got lower than average revenue growth, have actually delivered significantly better returns compared to their good quality counterparts. And I think that's an area of concern, and I would be very cautious. In fact, would want investors to stay clear of these kind of companies. And the opportunities actually lie in the good quality companies. And good quality companies are ones which we define as those which have better than average revenue growth and better than average returns on equity.
Interesting point. I would love to look at the details of that study, Vinay, how the lesser quality companies have delivered more returns and how it's probably time to go back to the good quality stocks. But talking about the good quality stocks, it's financials, which is called as, you know, the blue chip of sorts. The credit growth has been strong. The asset quality is pristine as compared to what we have seen historically. Why are the stocks then not reacting? What do you make of the underperformance of the private banking names?
Yeah, I think that's an area of opportunity, to be very frank, because there are lots of good quality companies or private banks, for example, or NBFCs, which have very strong structural growth ahead of them. These are the companies which have much higher than average return on equity, and they have clearly been stable businesses. So I think we are clearly overweight private banks, non-bank financial companies, and see this as a great source of opportunity.
So let me talk about certain areas of the market where the general consensus is that there are structural tailwinds. Then some of the companies are coming out with great numbers as well. So I want to talk about engineering and power transmission engineering, that kind of space. So what happened was 3-4 years, if you look at the landscape, everything got re-rated. Capital goods index itself went to a decadal high, and then things scaled back. Large cap as well as mid and small. Large cap has languished after that correction, has perhaps not come back in the same fashion. But mid and small, say a transformer rectifier, which is up 15% today, say a PAR, just naming for example purposes, these stocks have come back. Would you be cautious on this pocket? Or because the numbers as well as narrative both are kind of strong right now, you would still consider them investing worthy?
I think I would be extremely cautious within the mid and small cap space, because this is a space which is filled with landmines. There are exceptionally good quality companies. There are gems in this space, but this also has a lot of landmines. And I think many of these weaker companies or landmines are having been activated now. Investors need to be very careful, especially in the small and mid cap space, because I think the performance of all of these companies, especially starting from 1st of April of this year, has been far ahead of fundamentals in many of the cases. So I think that's an area of both concern as well as opportunity, and it's a stock pickers market out there in this space.
Hold your thought, because actually numbers for Titan are out and they look better than expectation. The profit figure has actually come in at 940 crore versus the expectation of 860 crore. It's the jewelry business that has delivered a 19% growth. The watches and wearable segment, a 32% growth in terms of the income. And if you look at the commentary coming in from the management as well, they are talking about that the festive season in Q3 has started well, and they are optimistic about the performance in the rest of the financial year as well. So the commentary coming in from Titan is also quite strong. They're also talking about how the store expansion in key market is progressing well. They're retaining their focus when it comes to the improving market share as well by launching differentiated products as well. The stock is seeing a bit of a spike. It was already seeing a up move of almost 1.5% to start the trade with, and now it's building on to gains 2.5%. I think the interesting bit also will be to watch out for the margin performance, because growth was something that they had given out in their provisional numbers already, but margin will be the key to watch out for, and we'll wait by to get more
Plus,
details.
of course, don't forget outlook for the next 2 quarters, because the ongoing quarter and the next one will capture bulk of the Dhanteras and all of that. Even What went by? What was that?
Dashera,
Dashera,
Navratri,
No, the other
Ganpati.
one.
There's just too much.
Yesterday, which was the most important
Halloween?
one.
No, I don't know what
No,
was yesterday.
I'm talking about whether.
No.
There are a lot of festival lined up.
Karwa Chauth.
Yes, that's the one. It was,
Your wife wouldn't like that. You're
well,
forgetting the
there
name
was
of the
puja at
festival.
home,
as
but
well.
I just forgot the name.
Okay, nonetheless, I think I do have the margin figure as well.
How much is it?
It's actually coming at 11.6%, which is lower than expected. And I think that is the reason the stock has actually reversed its course. Vinay, not about Titan specifically, but consumer discretionary as a whole. We have all been hearing about this premiumization, this affluent India. Do you think it will actually convert into spends and then higher, revenue growth for these companies?
It's actually happening as we speak because you look at consumer discretionary companies, or in fact, you look at retailers. Whoever is focused on urban India and more of the affluent segment of the market is actually doing very well. Whereas businesses which are focused on rural India or less affluent or the budget segment of the market are actually suffering. Look at car sales, for example. The budget cars are not selling, but the more premium end SUVs, the sedans, the luxury cars are selling very well. So I think that's a trend which we are seeing across the length and breadth of consumption. And that's a trend which might continue for a longer period of time for the simple reason the per capita income is going up sharply and the discretionary component is going up at a much faster pace.
Follow-up question on that one. See, up till now, Titan, even now, 60, 75, 60, 70 time forward kind of multiple they command, giant lions market share in jewelry retail, but they are getting some good competition as the regional players. Look at Senco Gold. Some of the most marquee fund managers have bet on it, right? Look at Kalyan. People are not ready to give it a chance and sample it. And when I say people, I mean a lot of fund managers coming out of South, aiming to become a pan-India play. But it appears that it is getting partly reflected in numbers and in valuations. Those attempts of becoming a pan-India play and replicate the Titan story coming similar to that, would you buy that argument or would you stay? Because over there the growth versus valuation is relatively lower, right? They're still 20, 25 times or even lower. Senco offering was 15 times, right? Just for example purposes.
Yeah, in my experience, Ajay, it's always better to buy a company for its own worth and not that it will be the next something. There is never the next something. The bellwether always remains the bellwether.
Talk to me about the real estate sector then. That's coming out of a slumber as well, Vinay. Would you buy that momentum and that trend?
Sorry, I was not able to hear your question.
Real estate sector, because that's coming out of a bit of a hiatus as well.
Sure. I think real estate has been the torchbearer of growth for the last 2 years. Extremely strong numbers, especially on the residential real estate side across the length and breadth of the country. And in fact, a lot of ancillary sectors to real estate are also doing very well. So I think that trend continues. In fact, the luxury segment of the real estate is doing far better than the budget segment. And once again, that continues with the discussion which we had just a while back now. And we expect this trend to continue. The sector is likely to do well. And even the ancillary sectors which are related to residential real estate should do well. So we are very optimistic on this sector person.
Before I let you go, just one quick question. One big overweight, one big underweight in terms of sectors?
Sure. So we are significantly overweight the healthcare sector and the financial sector. Within healthcare, we are overweight hospitals. Within financials, we are overweight NBFC and private banks. And in terms of underweight, we are underweight the IT sector and we are underweight industrial sector.
Vinay, good chatting. We should chat often now. You came after a long time. Good to see you in your new role as well, by the way.
Thank you.
So let's take a short break. On that note, our discussion with Mr. Chheda and Nooresh would continue on technicals. There are breakouts happening in several areas of the market. We'll talk about all of them right after this break. So discuss that with Nooresh because Nooresh was tracking that stock around 40-50 bucks if I remember it right and started recovering quite a lot. Is the current up move sustainable, Nooresh? Is there a trade here?
So, right from the time when it turned around at 50, 55 levels, it was change of trend for the whole new age companies. And one by one, everyone is surprised. It started with PB Fintech, then Zomato, then Paytm. Now, the case for Zomato is where does it stop in this rally? So, the first pause was at around 70, 80 levels. The next one came around 100. And now the bigger pause should come around that 125 mark. So, post listing, the stock had made a low of 125 for almost 3, 4 months. And once that broke, that was the start of a downtrend, wherein it went all the way to 40 levels. So for now, in this rally, one should be looking at booking profits totally around 125. And I would expect around 125 levels, or say 125 to 130 is the time where it should take a long pause.
Taken. We'll also get an analyst joining us soon to talk to us about the numbers, because right now we have very, few details available, because the proof of the pudding will of course be in the internals. What's happening to Blinkit? What's the commentary? What's the GMV? What happened of that platform fee that they had started charging? So all of these internals will be very important for Zomato going forward. But for the meantime, let's shift away from that and talk about some other, data points as well. Raymond for once was one stock that was reacting positively to its foray into the new vertical that he's looking at. New or rather the traditional one.
But I was very skeptical when the first time I said, what? Aeronautical engineering and defense and EV? But when we spoke to the management in detail, what they said was that they've acquired a company which already has the skill set. They have been working with all kinds of metal forging and metal engineering in their previous legacy business. When you infuse the two, there's a case that they can actually move forward. Plus, despite of this transaction, they remain net positive on the cash front. That was one of the biggest triggers to re-rate: debt reduction and improvement in cash flow. So that story is intact. That's what the kind of commentary we got from the group CFO Amit Agarwal earlier in the day. Let's get a small slice of that chat. The stock is gaining 4% in trade now.
The theme of the Raymond Group is that we want to stay in businesses where we have a scale and a size. Unless until we have a scale and a size, it is very difficult to create truly the shareholder value. So now with this foray, what we have got into a sunrise sector like aerospace, defense, and we have created a scale, and our demonstrated performance has shown that we are an operator who is able to reduce cost, reduce working capital, deleverage the balance sheet, and at an appropriate time, we've shown the demerger road to enhance the shareholder value. That's the way forward we have for this business. So I believe that in a consolidated level, if I look at the total business over the next 4 to 5 years, we see very clearly very high teens on the revenue growth and 20% plus growth on the EBITDA. So currently, based on FY 22-23 numbers, I think our combined pro forma business is 220 crores of EBITDA, which if you do 20% plus compounding, I think we can be comfortably more than 400-450 crore of the EBITDA over the next 4.5-5 years.
Okay, so that's a commentary coming in from the management of Raymond. In fact, Raymond and Arvind Fashion, both of these stocks were in focus on account of the recent news flow that we saw regarding the sale of its business to Reliance Retail as well, and that's the healthcare and fashion business. So before we go to that management interaction and as well as the discussion with our analysts as well, let's get the sense on the charts as well. Nirav, your take on the charts of Raymond as well as Arvind Fashions?
See, at this point of time, both are at different levels. Raymond has seen a very big rally, from sub 250 odd levels, and it continues to move up in the last couple of years. In fact, from 2020, it hasn't really seen a downtick. Per se on the longer term charts. At this point, again, I don't see much distribution. In fact, the chart is still positive, and there are chances that this stock can reach about 2200 odd. So, it would be a good level to enter again in this stock if you haven't already. Look to buy at current levels. Your stop loss would be around 1820 odd, which is a good support area. And you can look to book your profits anywhere between 2100 to 2200. I believe 100% retracement will come. For Arvind Fashion, it's at a different tangent at this point of time. No doubt, even this stock has gone up today. But last 2 years, probably year and a half, this stock has been in consolidation. and this consolidation doesn't seem to end at this point of time. So it's still in consolidation even after today's move. The consolidation will only end if the stock moves above the 380 levels on a weekly basis, closes the week above the 380 levels. So that is when the breakout will come in. Once that breakout comes in, only then you will see a bigger move, just like Raymond had in the last 2-3 years. That is how the move will come in, Arvind. So if you ask me which one to buy at this point of time, it is definitely Raymond to buy, and wait for Arvind to break out about the 380, only then buy. The targets post breakout would be around the 600 650 odd levels. I'm seeing a medium term perspective at this point.
Okay, point taken. So that's the take coming in on Raymond as well as Arvind Fashions. But time now to slip into very short break. So let's do that. We are getting more details as far as Zomato business is concerned, but we'll analyze that once we come back from this short break.